Welcome. Today's deep dive is really custom tailored for you, the retail investor who's trying to cut through all the noise and financial reports and,
Right.
well, and truly understand a company's health.
And our subject today is a major player in the Turkish technology market, Arena Bilgisayar Sanayi ve Ticaret A, or as we'll just call them, the group.
Right.
We spent a lot of time dissecting their interim consolidated financial statements and their activity report for the 6 months ending September 30, 2025.
And the goal here isn't just to recite numbers.
No, not at all. It's about recognizing the dramatic narrative that's really embedded within them. It's a story of operational strength clashing head-on with some severe financial pressure.
Okay, let's unpack this then. We're looking at a huge technology distributor. It's operating under, extreme economic conditions, executing a major asset sale, going through a massive personnel reduction.
And at the same time, trying a strategic pivot toward high-tech solutions like AI.
Exactly. So the core mission today is to answer the big question. How is Arena navigating all this turbulence? What is the true state of their liquidity? And what does their financial roadmap tell us about their future viability?
It's a genuinely fascinating snapshot of a high-volume business in a hyperinflationary environment. I mean, the document is just full of these dramatic swings.
Oh, so?
You see strong cash generation in one area, only for it to be immediately neutralized by, frankly, catastrophic expenses in another. Understanding these flows is paramount for anyone even considering investing in this market.
Absolutely. And before we really jump into the details of the balance sheet, if you find this analysis helpful, please take a moment right now to like this deep dive, subscribe to our channel, share this content, and, hype it up in the comments below.
Your support really does drive these in-depth explorations.
Let's first get to know our company a little. Arena Bilgisayar was founded back in 1991. So for the learner just catching up, what is their core business today? What's their bread and butter?
Arena's identity is really built on large-scale distribution. They're a critical logistical hub in the tech world. Their main activity is the wholesale trade of computers, peripherals, consumer electronics, telecom products.
So they're not manufacturers. They're the ones moving the boxes, the supply chain experts.
Precisely. They source these goods both domestically and internationally, then distribute them to customers all over Turkey and the Turkish Republic of Northern Cyprus. Their strength is their network.
Okay, and where are they physically located?
Their main headquarters is in Istanbul, in the Eyüp district, and they have one branch office in Ankara. And because their business is all distribution, their infrastructure is focused on warehousing, logistics, robust sales networks, not factory capacity.
Got it. And that network, it extends globally through their subsidiaries, all of which they own 100%.
But
So tell us a bit about their footprint.
internationally, the most notable one is Arena International FZE. It's strategically located in the UAE's Dubai Free Zone.
Ah,
This entity handles the international trade of IT materials, and crucially, it uses the UAE dirham as its functional currency, which helps manage some of that cross-border risk.
and domestically.
Domestically, they have several specialized arms. Arena Mobile focuses heavily on the wholesale trade of mobile phones and devices in Turkey, and that's a significant segment, as we'll see in the sales mix.
And this brings us to what feels like the most interesting structural change, the strategic pivot embodied by Arena Labs.
That's the critical element of their future planning. Arena Labs, Technology Suzum, AHI, it underwent this formal, really dramatic pivot in March of 2025.
A pivot away from what?
It consciously moved away from its previous e-retail focus, its new mission, concentrating exclusively on artificial intelligence activities and big language models, LLMs.
So this is management signaling a decisive shift, moving away from thin margin commodity distribution towards what? High value, high tech service revenue.
That's the plan. That's the signal they're sending.
And that kind of pivot, it requires capital and focus. They also have Paynit for payment services in Northern Cyprus and Arena Connect. We should probably remember Arena Connect, right? Because its recent contract sale is the direct mechanism funding that AI strategy.
That's exactly right. The sale of that contract, which we'll get to, is a tangible sign that this AI pivot isn't just some mission statement on a slide deck. It's an active divestment strategy.
Let's talk about the human element here, their personnel. The report shows a surprisingly dramatic contraction in the workforce over just 6 months.
The numbers are stark. The total employee count dropped from 279 staff at the end of March 2025 to just 217 as of September 30th.
Wow, that's a 22% reduction in staff. In half a year.
It is. A 22% downsizing in 6 months implies a comprehensive, very rapid restructuring.
So what are the implications of that for you, the retail investor?
Well, it speaks volumes about management's urgency regarding cost control and operational streamlining. You can directly link this reduction to the Arena Connect sale and, shedding those past e-commerce efforts through Arena Labs.
So they're relying more on automation.
The implication is a major reliance on automation, likely through the very robotics process automation, the RPA, that they're developing in their R&D center to maintain operational volume with fewer people.
And the downside.
While it drives efficiency, such rapid cuts often lead to high short-term severance costs, which we actually see in the executive compensation figures. And it carries a significant risk of losing specialized institutional knowledge very quickly.
Looking at their financial structure now, their registered capital ceiling is 500 million TL, but the issued and fully paid-in capital is stable at 100 million.
Yes. And regarding ownership, the major shareholder is Redington Turkey Holdings, holding about 49.40%. For the retail investor, the publicly traded ratio is high, sitting at 50.60%.
So a deep public float since they listed back in 2000.
A very deep float.
Let's briefly touch on corporate governance and leadership costs.
The board structure has 5 members, and critically, it includes 2 independent members, which is a good sign for compliance and oversight.
What about diversity?
The report is a bit thin there. It only notes 1 female executive among the top management team, the VP of Human and Culture.
And compensation.
Total remuneration paid to upper management. And the board for the 6-month period was 38.78 million TL, which is relatively stable compared to the prior period. But, and this is important, we have to note that the 2025 figure explicitly includes severance pay for some executive personnel.
Which again underscores that ongoing high-level restructuring.
Exactly.
So here's where we connect the company's internal dynamics to the external pressures. Arena operates in IT distribution, consumer electronics, telecom. What defines this competitive landscape in Turkey today?
It's a market defined by 3 things: speed, complexity, and razor-thin margins. These sectors are characterized by rapid technological obsolescence. What you sold last quarter is often discounted this quarter. There's intense price competition, and they have to manage complex supply chains that require heavy use of foreign currency. Arena itself acknowledges this by listing continuous change as a core principle.
They aim to be the market leader. How is their sales mix structured, and are they actually winning that market share? Let's look at the product breakdown first.
Right, so analyzing the first 6 months of 2025, and this is in US dollar terms, we see a really heavy reliance on mobile devices. Phones account for 45.3% of net sales.
Almost half their business.
Almost half. Personal computers follow with 16.2%, and corporate products are at 15.6%. This product mix means Arena is highly exposed to consumer lending cycles and import costs, which makes them very susceptible to the volatility of the Turkish lira against the dollar.
Now, for the strategic shift in their sales channels, where are customers actually buying from Arena?
This is a massive strategic story playing out right here. Comparing 2025 to 2024 results, again in dollar terms, sales via the traditional BEI, that's the dealer or reseller channel, they decreased sharply, down over 21%.
So a conscious pullback.
A very conscious pullback. In contrast, the Perikin, or retail channel, those sales surged almost 38%.
Wow.
It now constitutes nearly a quarter of their total sales. We also saw solid growth in top 10, or wholesale sales, up about 26.43%.
What's the implication of this transition? It seems like they're exiting that complicated dealer landscape.
Precisely. They are deliberately moving away from servicing a large, fragmented network of individual dealers towards centralized, high-volume transactions with major retail chains and large wholesalers.
Which simplifies their credit risk management, in theory.
In theory, yes.
Yeah.
And it dramatically improves logistical efficiency and scale.
Right.
But it also means they face intense pressure on pricing from those large retail buyers. So they're basically trading complexity for volume leverage.
Okay, let's connect these operational realities to their financial standing, using a quick SWOT analysis from the report.
Sure. We can start with strengths. Their high-volume operations generate inherently strong operational cash flow, as we'll demonstrate. Their diversified sales channels, though shifting, offer resilience.
And that credit rating is key, right?
Crucially, yes. Maintaining an investment-grade JCR-A rating signals structural stability to creditors. And their government-approved R&D center status is a huge advantage, providing vital tax incentives for their pivot.
What are the deep structural weaknesses that seem to underpin their profitability problems?
Well, the core weakness is the distribution industry itself. I mean, you have traditionally low gross margins, currently sitting around 5.5%.
That provides zero margin for error.
None. And then you see their high dependency on managing foreign currency exposure, and most damagingly, their vulnerability to massive finance costs because of high leverage. And we just can't ignore the fundamental risk of relying on converting enormous trade receivables into cash.
On the opportunity side, how do they plan to grow beyond this margin squeeze?
The primary opportunity is that strategic pivot into high-value services, particularly AI, LLM, and robotics, through Arena Labs. If that's successful, it changes their margin profile entirely.
And they've shown some financial agility, too.
They have. They demonstrated it by leveraging VDMK securitization asset-backed securities, which allows them to monetize their receivables quickly for liquidity.
And finally, the very real threats facing the company, most of which seem systemic.
The threats are existential. First, high domestic interest rates translate directly into crippling finance costs that consume all the operational gains.
You'll get to that.
Second, and just as damaging, is the escalating credit risk exposure. This is evidenced by the gigantic doubtful receivables provision we're about to discuss. And finally, just the structural complexity of operating in a hyperinflationary environment, which forces them to apply TMS 29 accounting standards, adds a layer of systemic risk that's just impossible for management to fully control.
Now we can move on to our analysis. We will review the key metrics for the 6 months ending September 30, 2025, paying close attention to the structural drivers behind the numbers that you, the retail investor, must understand.
Right. Let's shift our focus from strategy to the outcome and ask where every dollar generated by this massive distribution engine ultimately ends up.
Let's start with revenue. The top line looks good on the headline currency. Revenue in Turkish lira came in at 18.39 billion TL. That's a nearly 20% increase year over year.
And this is the first moment where we have to be critical. Because Arena trades internationally and sources its goods globally, the true measure of volume and business growth has to be viewed in the functional currency.
Which is the US dollar.
Right. And when we perform that translation, the revenue is $463.6 million US dollars, which is essentially flat, a negligible decrease of 0.45% year over year.
This is such a crucial distinction for investors. It tells us that 100% of that lira revenue growth is purely a function of inflation and currency depreciation.
The company's real-world sales volume has stagnated.
They're running hard just to keep their absolute market standing, measured in a constant currency.
Exactly. Stagnant volume might be acceptable in a recessionary environment, but it shows they're not winning new real market share. They're only keeping pace with rising prices.
And gross profit.
It followed suit. It increased to 1.02 billion TL, but the gross profit margin slightly compressed from 5.69% to 5.56%. This just confirms that continued intense competitive pricing pressure on every single sale.
Now we move to operational expenses, what you called the profit killer. Total operating expenses. They surged from 465.4 million TL to 926.6 million. That's nearly double the operational cost.
And the explosion happened in general management expenses, which soared by 186% to 608.6 million TL. The single overwhelming driver here is the 322.4 million TL provision for doubtful receivables.
Okay, let's dedicate a moment to that 322.4 million TL. For the retail investor, what does that provision really represent?
It means that Arena sold goods on credit. They recorded 18 billion TL in revenue. But then they had to formally recognize that almost a third of a billion lira of that revenue is likely never going to be collected from their customers.
So it's a non-cash charge, but it's financially devastating.
It's management admitting a systemic failure in credit risk management, or maybe a major increase in customer bankruptcies, which directly wipes out any potential operating profit they might have had.
And the consequence of this credit failure is immediate and dramatic in the operating profit line.
It is. Operating profit swung from a profit of 241.3 million TL in the previous period to a stunning loss of 38.5 million TL now. The operating margin is negative.
Negative 0.21%. This figure tells the whole story.
It really does. Arena's core high-volume distribution activities are fundamentally unprofitable when the reality of credit risk is factored in. The high volume is only generating losses.
And as if that operational deficit wasn't enough, we now have to account for the massive drag created by the high interest rate environment.
The net finance expense is punishing. It increased by nearly 30% to a colossal 942.1 million TL for the 6-month period. I mean,
Wow.
to put that into perspective, the operational loss of 38.5 million is dwarfed by the cost of financing. This figure includes 275.3 million TL spent just on factoring costs.
Which means they're selling their receivables at a discount to banks to get cash now rather than waiting, 86 days?
Exactly. This proves that liquidity is a serious daily concern for them.
This interest expense is almost a billion lira over just 6 months. That is the true tax on high leverage in this economy.
Absolutely. The interest paid is not just high, it's structural. The rates on TL loans are astronomical, often ranging between 43% and 55%. That cost is consuming everything.
So the final result.
The final result is a massive net period loss of 711.6 million TL. That's nearly 140% higher than the loss recorded in the prior year. The net profit margin is a deep negative 3.87%.
So Arena is generating volume for the benefit of its creditors.
That's a good way to put it. Not for its shareholders at the moment.
Moving to the balance sheet. Total assets increased slightly in TL terms, but consistent with the revenue, when you convert it to US dollars, assets actually decreased by over 7%.
And again, we see inflation masking a real asset value decline. Let's focus on liquidity. Cash and equivalents dropped sharply by almost 60% to 176.7 million TL. That drop is concerning for a distributor that needs readily available cash.
But the lion's share of their assets is tied up in trade receivables, which increased almost 19% in lira and now dominate the structure, making up over 82% of all assets.
And this is the fundamental financial weakness we just saw in the income statement. The average collection period for those massive receivables worsened dramatically. It jumped from 71 days to 86 days.
That 15-day extension is a critical warning sign.
It is. Every extra day those receivables are outstanding, it increases the risk of default and directly fuels the need for those large doubtful debt provisions.
On the working capital side, inventory is down significantly, over 32%.
That's a good sign of proactive management. By reducing inventory, they're cutting their exposure to fluctuating prices and, crucially, reducing the need for expensive working capital loans to finance that stock.
Let's discuss the major non-cash impairment hit, goodwill.
This is a dramatic disclosure that often gets overlooked. Goodwill, which previously stood at 250.2 million TL, was eliminated entirely, written down to zero.
And what does that mean in plain English?
Goodwill represents the premium Arena paid over the fair value of assets during past acquisitions. It's essentially a bet on the future profitability of that acquired business.
Yeah.
By writing off the entire amount, management is formally acknowledging that the expected future cash flows and value from those past acquisitions, well, they failed to materialize.
So it's a permanent structural blow to shareholder equity.
A permanent blow.
Turning to liabilities, short-term obligations have increased, but let's look at trade payables.
Trade payables increased to 7.25 billion TL, a rise of over 25%. And what's more, the average payment period to their suppliers also increased from 49 days to 57 days.
Which is a deliberate tactic.
It's a deliberate and essential working capital tactic. They're maximizing the time they take to pay suppliers. In effect, lengthening their payables is providing Arena with a massive, short-term, interest-free line of credit from its vendors, which, as we'll see, is absolutely vital for their operational cash flow.
Given the low cash balance and the slowing collection of receivables, how acceptable are their current liquidity ratios?
The current ratio dropped from 1.24 to 1.15. Now, while technically that's above 1, in a volatile market where your primary asset receivables is risky and liquid, 1.15 is cutting it very close.
And the quick ratio?
The quick ratio, which excludes inventory, is maintained at a razor-thin 1.01. This figure just screams high dependency. It confirms that the company must liquidate its trade receivables into cash virtually immediately to meet its short-term obligations. Any further slowdown in collections could trigger a liquidity crunch.
Let's discuss leverage. The net financial liability increased to 3.62 billion TL.
And here is the core structural risk. Bank loans and trade payables combined now represent a staggering 77% of their total funding. That's up from 69% previously.
And this extremely high leverage, combined with the domestic interest rates we discussed.
It explains the near billion lira drain in finance costs. The company is leaning very heavily on debt and supplier credit.
Finally, their FX position. For a major distributor that imports heavily, how vulnerable are they to currency shocks?
Despite the US dollar being their functional currency, which helps hedge core transaction risk, they still have a negative net exposure in both their reporting currency, the lira, and in other foreign currencies.
So if the lira depreciates sharply against the dollar,
Those negative positions immediately translate into financial losses. They are still exposed to FX volatility on their internal financing lines and some localized assets and liabilities.
this brings us to the fascinating cash flow paradox. So Arena suffered a massive 711 million lira net loss, yet they report strong operating cash flow. How does the operational engine manage to generate cash while the P&L shows a catastrophe?
This is perhaps the most important lesson for the retail investor reading any financial statement.
Yeah.
The net loss is primarily driven by non-cash items, like that 322.4 million lira doubtful receivables expense and amortization,
Right.
and the enormous financing expenses. These expenses appear on the P&L, but they do not represent cash leaving the business from operations.
So if we look at cash from operations, they generated a robust inflow of 1.36 billion TL.
That operational strength is undeniable. It's fueled by adding back those non-cash charges, and most importantly, by highly efficient and aggressive working capital management. Specifically, that massive increase in trade payables of 1.42 billion TL.
So they're using supplier credit to fund operations.
Exactly. And they also freed up cash by reducing inventory by 840 million TL. The operational machine moves goods efficiently and manages its non-cash resources effectively.
The operations are healthy, but where did that 1.36 billion lira in cash go?
It was immediately neutralized by the cost of capital. Cash from financing showed a massive outflow of 1.64 billion TL. The largest component of this outflow is the interest expense, which totaled 980.6 million TL paid out the door.
Up substantially from the previous period.
Significantly.
The conclusion on cash is clear. Arena is excellent at generating cash flow from distributing products, but the corporate structure is acting like a black hole. High leverage and high interest rates consume nearly every lira of operational cash flow, leading to that sharp drop in the ending cash balance.
It's a classic case of the operational machine being profitable, but the financial structure being the anchor. They are making money for the banks, not for the shareholders at the moment.
And shareholders' equity took a hit, decreasing from 3.17 billion TL to 2.47 billion.
That 711.6 million lira net loss directly consumed a portion of their accumulated reserves and profits. This has a direct impact on their resilience.
So their cushion is shrinking.
Right. Consequently, the equity ratio, the shareholders' cushion, dropped noticeably from 23% to a much riskier 17% of total assets. The lower that ratio, the more leverage the company holds, and the less buffer they have against future losses, like that goodwill write-off.
Paid-in capital remains stable at 100 million TL, far below the 500 million TL registered ceiling. Let's look at those critical footnotes that clarify what management is doing.
Okay. First, credit risk mitigation. Given the massive credit risk we've highlighted, management uses credit insurance Coface and Turkey Sigorta, covering about 1.1 billion TL of short-term receivables.
But that's only a portion of the total risk.
Exactly. It's necessary, but it only mitigates a portion of the risk when 82% of your balance sheet is tied up in customer debt.
Second, the VDMK activity, the asset-backed securities. Tell us more about how they use this.
This mechanism is a key sign of financial sophistication. Arena used VDMK through FIBA Banca, essentially bundling a pool of their high-quality trade receivables and selling them to raise immediate cash.
And they have a high ceiling for this.
A massive 10 billion lira ceiling. They successfully issued and quickly repaid nearly 500 million lira of VDMK during the period. This shows management's ability to securitize assets for short-term financing, which is crucial when traditional bank lending is too expensive.
And finally, the R&D status.
Their R&D center approval is directly linked to their strategic pivot. This status provides essential government tax benefits for their ongoing projects in AI, LLM, and robotics process automation, which undercuts the expense of funding their future strategy.
Let's focus now on the major asset disposal. This ties directly back to the funding of that AI pivot.
The key transaction was the sale of Arena Connect's distribution contract with Vodafone to Datagate Bilgisayar. The deal was finalized in September 2025, valued at $8 million plus VAT.
And the immediate financial impact showed an accounting loss, correct?
It did. The transaction resulted in a 63.8 million TL accounting loss, which included all the associated severance and transition costs. However, it generated significant liquidity in the form of 331.9 million TL in short and long-term receivables from the sale price itself.
So strategically, why incur a financial loss to sell a contract?
The rationale is pure focus and funding. Management is intentionally shedding high-volume, lower-margin contracts that require intense working capital. They're freeing up both cash and management attention.
To redeploy it.
Exactly. The $8 million in proceeds, plus the operational capital released from managing that contract, is earmarked to fund the core investments in higher-margin areas, Core BT, robotics, and the AI investments at Arena Labs. They're cleaning house to dedicate resources to the future.
And that structural cleanup aligns with their recently confirmed credit rating?
It does. Despite this staggering P&L loss, JCR Eurasia confirmed the group's credit rating at ATR with a stable outlook. This maintains their investment-grade status, which is essential.
What does that signal to creditors?
It signals that creditors view the company's underlying distribution network and balance sheet capacity as fundamentally sound, even if profitability is currently ravaged by macroeconomic factors like interest rates and credit risk.
They also shifted their fiscal reporting period.
Correct. They moved to a special accounting period running from April 1st to March 31st, starting in 2025. This change just standardizes their comparative reporting going forward.
And lastly, the company published its 2024 sustainability report.
Yes, this is a matter of regulatory compliance and governance. As a large entity meeting certain thresholds, Arena is subject to the mandatory Turkey sustainability reporting standards, showing their commitment to transparency.
To conclude, how is management positioning the company's future given the severe net loss and the high leverage?
Management's focus is on market reassurance. The board confirms that the financial statements accurately reflect the situation, and they emphatically state that the company's capital is not impaired and that they are not over-indebted, despite the 77% leverage ratio and the massive losses.
And what's the official strategic direction for increasing investor value?
The official goal is to efficiently manage product supply while driving growth through high-value services. The real story here is the necessity for that strategic pivot into AI and advanced tech solutions, leveraging those R&D tax incentives. The very profitability of the company hinges on this transition succeeding.
So for you, the retail investor, what are the top two challenges that must be fixed for Arena to become a profitable entity again?
Well, the challenge is translating that robust operational cash generation into net profit. Future profitability rests entirely on fixing the financial structure.
Number 1B.
Reducing the cost of financing. The 980 million lira interest outflow is a slow-motion catastrophe. This requires either a dramatic reduction in domestic interest rates or a successful strategy to convert that expensive short-term TL debt into cheaper, longer-term funding.
And number 2.
Aggressively controlling and collecting receivables. They must fundamentally tighten their credit terms to prevent another 322 million lira provision. That worsening 86-day collection period has to be reversed through stricter customer checks, demanding better collateral, and just ruthlessly enforcing payment terms. If they can't collect the cash from high-volume sales, the entire model is broken.
The success of Arena Labs is effectively the Hail Mary pass here. It's the necessary antidote to the structural distribution squeeze. If they can capture high-margin service revenue from AI and RPA, it could provide the profit cushion to absorb the volatility and finance costs of the distribution business.
Think about the scale of it. To offset a nearly 1 billion lira annual finance expense, they need to generate hundreds of millions in high-margin service revenue from Arena Labs, and quickly. The $8 million divestiture provided seed capital, but the true investment required in talent and infrastructure to compete in the global AI space is immense.
So they're in a race against time.
They are. They're trying to build a new premium business fast enough to support the debt load of the old commodity business.
This deep dive has revealed Arena Bilgisayar as a high-volume distribution engine that is currently hemorrhaging cash due to severe credit risk and astronomical financing costs. The operational strength is clear, evidenced by the robust cash flow, but the financial structure is actively destroying shareholder value, as seen in the shrinking equity ratio and the complete write-off of goodwill.
Management is demonstrating agility. That VDMK activity and the AI pivot are smart moves, but the structural debt and credit risks are actively consuming the capital cushion. The retail investor must monitor those receivable collection periods and the net finance expense above all else.
It puts the strategic timeline under the microscope. Considering the 77% leverage ratio and the almost billion lira annual drain in interest costs, the question for every investor is, how quickly must the AI pivot succeed to compensate for that relentless outflow? And what happens to Arena's liquidity if that 86-day collection period pushes past 100 days?
The operational efficiency is proven, but the sustainability of the financial structure in this macro environment is their defining existential challenge.
Remember to like this deep dive, subscribe to our channel for more insights, share this analysis with anyone interested in the market, and let us know your thoughts on Arena's ability to execute that critical AI pivot in the comments below. We appreciate you joining us.